Good afternoon. I'm Roy Weiler, the Director of Trading Operations for Time Leverage Capital. For anyone who's missed our previous webinars, please give us a call at 800-519-9085 and we can send the videos you missed, or you can browse by topic on the Option Ranger website under Demo Videos. If you're a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so that we can prepare a lesson plan based on your level, at your pace, and on your schedule. For an important disclosure, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please be sure to read and understand all disclosures before investing. All of the examples discussed today are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, please type them into the chat box and we will do our best to answer them. Our presenter today is Mr. Adrian Mueller. He's the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends, an all markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage, Time Leverage Capital, and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our Bear Put Spreads for a Downside Move with Undecided Volatility. Mr. Mueller?
Thank you, and welcome to our presentation today for the Bear Put strategy, and let's go ahead and go through our process for examining trades. First of all, let's look at the scenario when a bear put is used using our volatility and directional grid. In this particular case, the outlook of a person who's buying a bear put spread, as the name implies, is bearish. So this is a strategy for people that are expecting a downward move in the market. The second criteria that we use for selecting a strategy, as developed over many years by the exchanges and demonstrated in various option manuals, is to look at the volatility outlook. So a bear put spread, a one-by-one put spread, is again a directional trade that is bearish, looking for the market to drop, and the volatility outlook for a bear put spread is an undecided outlook. So person who buys a bear put spread is looking for the market to go down, but does not have an expectation of steeply rising volatility or exacerbated movements, nor do they have an opinion that the volatility or the movements are going to slow down. Rather, there's no real opinion. There's a sense that the market's going down, but perhaps at a similar pace or without a significant change in volatility, or without a view whatsoever on volatility. So when you look at the bear put spread, these are the particulars. Whenever you see a trade like this, you can click on it. When you click on it, it'll open your next window where that particular trade market is defined. You see a very commonplace grid of how these trades are described that shows you that your profit scenario is limited to the difference of the put strike price that you purchased and the strike price that you sold. So it's the premium that you collected in the middle minus your transaction costs is your maximum profit potential, and your risk, as you can also see, is limited to the amount of the debit. The description is over here. So again, if you're looking for a market to be moderately bearish, to go down somewhat, or at least that it is more likely to fall than rise, then one of the strategies that can be used here is to use a put spread, and that changes the risk of establishing a bearish position using either an outright futures or or purchasing an outright put. As you can see, in addition to the grid with the explanation, we also have a video, and this video library is growing at all times, where you can see previous webinars with examples of bear put spreads so that you can get further familiarity with the strategy and the different circumstances and the different numbers. And you can also, of course, go to our reference material section, go to demo videos, and you will see the strategies listed here, both for demos and for actual trade inputs. Having reviewed the basics of a bear put spread again, which looks for a market to drop with undecided volatility, we will look at 3 examples today, and today is March 20th, so these are examples that we are trying to make. They're not trade recommendations, they're just examples of how the calculations are input on a put spread and how to interpret the output on the trade. So first, let's go to the July coffee market. And in this particular case, once these trades have been saved, all you need to do is click on the date trade. You'll see the particulars and you see the inputs. So these may not be current prices, but they are prices used for purposes of illustration. And these would have been, I believe, yesterday's settlement prices. So let's have a look now. When you select the market, you click on the box. In this particular case, the contract comes up. It's coffee. One contract is 37,500 pounds. So if there's a penny move in coffee, you multiply 37,500 pounds by the tick value. So if there's a 1 cent move, you will have a move of 37.50. Excuse me, a 10 cent move is 37.50. A 1 cent move is 375, and you can do the math on this on the grid. You also see the complete contract specs here. So if you have an interest in getting further information on the coffee market, as you can see, there's a dialog box here. It opens up with another helpful link that will take you to the contract specs. So when you select coffee in this case, if you want some more information about coffee, you get the particulars, the contract specifications, trading hours, and in the right-hand column you have our list, and we're always open to more suggestions of primary and secondary sources for information of what one should follow when speculating or doing any trading in the coffee market. Some of these are general points to follow. Others are actual links to primary sources that update regularly and provide essential information. So let's go now. We're back at our coffee example. We already input a put spread. We input a cost factor. We input output rows. And again, the composition of a put spread is listed. You buy a put, in this case closer to the money. You sell a put farther out of the money, buying the 175 put and selling the 165 put. The premium paid, and again, when you click on strike price, if you're not sure how to calculate or input those, the minute you click on this, the dialog box comes up, also with a link to further explanation. And also when you input premium, you get a premium example of how to input, as well as a link to further descriptions. Learn about the coffee market, which is a very volatile market, especially when weather is involved, supply and demand. So let's have a look at the particulars of this trade. Now all that does, that 37,500 pounds get translated into dollars and cents. So when one buys that coffee put at a strike price of 175, they pay a 9.3 cent premium, which is 34.8750. The calculation is right there. And on the 165 put that was sold, that was done at 5.3, which is 1988, for a net debit, that's right, it's in red, of 1,500. So the purchaser of this put spread would have an outlay initially of 1,500 in premium. Then, of course, like any good business person, you factor in the cost of the transaction, and you come out with a total debit. A bear put spread, as long as there is one long put for every short put, is a non-margin trade. So that the maximum risk, as indicated before, when we looked at the particulars of the bear put spread, is again that the risk is limited to the differential, to the premium and fees paid for the spread. And this trade does suffer from time decay, so if there isn't a move in the direction, it's a bearish market. It doesn't happen large enough to get into the range, then time erosion will be harmful to this trade. So when you pay a debit for a bear put spread, you can't sit still. If the market doesn't go your way, you have to start thinking of an exit strategy, and we'll have a look at that on the spreadsheet. So now again, we're back to our particulars. We have a trade that is a total of 1610 net credit debit, and just as indicated in the grid, that is the maximum loss on the trade. Whether or not one has a deep grasp of the fundamentals on this market and all the details of options, just putting in the inputs helps one realize what the maximum risk and what the maximum profit potential is, which is very helpful, because if this maximum risk number is not suitable for somebody, they won't take it. And certainly if there's a margin risk for people that can't tolerate margin risk, they won't do that. Again, this trade has a predetermined and limited risk, so the net debit that is initially paid in the case of a bear put spread is always equal to the maximum loss that is possible on the trade. In this particular scenario, because of the amount of premium that was paid on the trade, there is a high break-even point on premium of 4.29. So when one gets quotes on coffee prices and gets quotes on these positions, in order for them to offset that position in premium profitably, they have to overcome all the costs and have to sell it essentially for more than 4.3, if you will, in premium. And every cent above that is a gain of 375. Every cent below that is a loss of 375, down to the maximum loss and not more. The maximum profit potential, again, is the differential between the two strike prices. So it's 10 cents minus the premium paid, which is 4.29, and that will give us the break-even the break-even point on the futures at 170.71. So in this particular scenario, the market would have to break down under 170.71 at expiration or intrinsically in order for the trade to be profitable or in the money based on intrinsic value. If a person looks for a volatility play, you have to look at the 430, and if you're looking for a longer term or a trending move, you have to have some confidence that the market is going to find its way under 170 and ideally expire somewhere closer to your objective of 165, because under that objective, the next person takes over the profitability. And let's look at the numbers themselves, which is the most important thing. We have a review of the tick values, and then as you can see, no matter how far down coffee goes, once we get past our break even, once we get to that 1650 ideal target, the maximum profit of 2140 has been reached, and no matter how much further the market drops in a bearish move, that is the most that can be made on this trade, because the profits, if you will, beyond this level, or any intrinsic value or value beyond that place, is going to belong to the person who paid, in this particular scenario, $1,988 to purchase that 165 put. So basically, by reducing the cost of the spreader by almost $2,000, this person does have the right but not the obligation to try to take advantage of any large and explosive move down under 165. The loss scenario, as well, as you can see, if this person is bearish coffee but they're mistaken and coffee just takes off, maybe there's some other weather event or some instability, or in Brazil, or some demand issue, or maybe something come out of production in Vietnam, any scenario that you see in the what to watch section, and this market rallies significantly, no matter how much the market rallies, just the way that the gains are capped on the downside because a put was sold. Likewise, as you can see, in case of an up move, having purchased a long put, the maximum risk cannot go up, and if we increase this grid to $2 or $2.20 to $2.50, it doesn't matter. This would be the maximum risk. As with all trades, one should have a risk management strategy in order to exit this position if the outlook is not confirmed, and a bearish move doesn't happen in time, then they have to be mindful of time decay and come out. The next example that we're going to look at again now, and again it's on the same scenario. We're looking for a bearish outlook, but an undecided volatility expectation. In this case, now we're going to unexpect, and in this particular case, we're looking at the wheat market. The particulars of the trade is that there's a $7 put purchased for 43.5 cents, and that there's a $6 put sold for 8.5 cents. If one is not sure what all that means or wants to see what it means in dollars and cents, we click on the trade, and then we immediately call up the trade with all its particulars. In this case, it's 5,000 bushel contract. So every penny move is a penny times 5,000 is $500. A dollar move is $5,000, and the minimum ticks are listed. Again, we go to the contract specs, just in the case of the coffee, and we have inputs of strike prices and examples. Now let's go ahead and see how this particular bearish trade would look. As you can see here, again, the scenario is that person was looking for a drop, but without rising volatility. So at the strike price written, at the strike price where one maxes out at $6, as you can see, no matter how much more the market drops, the gain here is fixed at 3,140. And the break-even, if you look at all the particulars here as before, in the break-even box you see a futures break-even, which is the market has to move below 662.8, and the premium that can be collected has to be greater than the 37.2. As before, no matter what happens, the maximum risk is limited, and again, the number for maximum risk will be the same as the number for the initial debit that was paid for the entire position, and the loss cannot be greater. In this particular scenario, as you can see, we're looking for somebody's looking for a pretty steep move, and they need this market under the scenario at expiration to be under 662.80. So if one doesn't have the opinion that the market will trend down or drive down to that number or beyond to the downside, then based on these particular inputs, the trade would not be done. This person also has to have a fairly strong feeling that they are by reducing their cost at the $6 put price, that they are not in fact foregoing gains. If they think the market will drop more explosively, then they will have to make a change. So let me just suggest an example. Let's say for somebody in this particular scenario is thinking, well, I'm going to be even more bearish, and then of course they have to think if it's whether or not it's worth for them to collect those 8.5 cents. But let's say a person says, you know what, I want a little more cushion. I think this thing could go to 580. And again, we're not suggesting it's going to 580 or on any other number. We're just demonstrating a feature where the price can be easily changed manually just in the one box. Then we're going to change the premium on that, and without having to input all the numbers, we're going to get a new spreadsheet with new inputs. So what is the as opposed to the $6 put, what is the premium for the 580 put, please?
In wheat, hold on.
In wheat, we're looking at the July 580 put, and we've just looking to widen this spread, and as you can see, it's already listed here.
It's at 5 cents.
So we can always click back and forth and compare. So this one's at 5 cents. So let's just put in 5. And again, as you know, we have a feature to email this straight to a friend, to print it so we can make notations on it, to save it under a tab if we want to, or to post to a forum for feedback or just as a suggestion to others to begin a discussion. We hit the calculate button, and you're going to see two things. First of all, in case you want to compare this trade and look at it, it gets listed at the end of your trades here, and you can easily click back and forth and compare the costs, the risk, the profitability ranges. Literally click back and forth, and you will see that the which position is more in line with your expectation or the expectation of the analyst that you may be following. And we see the change on this trade now. You see the person's only collecting $250. So the net difference is greater. The net cost of the trade is greater because this person had collected had collected 5 cents or about $2.50 versus over $400. So all the numbers change accordingly. The maximum loss is greater because the maximum initial outlay is greater. The break-even point on this particular case requires a slightly larger drop because there's more of a premium to overcome. There's a higher break-even on premium because less money was collected on the right. However, by the same token, the profit potential has been increased by $1,000 because the short put has been moved over by 20 cents, which is 20 cents times 50 is 1,000. So if you look at this particular scenario now that you see on a large drop, a drop past the objective of 580 is 39.65. It's a bigger gain, and on an ongoing drop, the gain would be larger. However, by the same token, the initial outlay is greater, so if there's no adjustment or offset made, the total risk and the total premium cost that are at risk in the position is $20.35 for the initial debit. Again, if you spend that kind of money on a spread, you should have some sort of an exit strategy or position monitoring strategy in place to offset the position at any time, whether it's because you're making money, losing money, or just changing your mind. And that change of mind can be followed in the dynamic option strategy section. Finally, we have a third example today. If there are no questions on this, which is a July put spread. Again, somebody might have an outlook that they think that silver perhaps should correct at this point for a variety of reasons, whatever those reasons might be, but they think that they don't believe that the market's going to correct significantly under 18.5 cents. So in order to reduce the cost of speculating on this drop, a person would buy a 20.5 put, but because of their uncertainty or lack of major expectation of volatility, they would mitigate the cost and the risk of this position by capping the profit potential on a drop below 18.5 in exchange for the 4 cents, and let's see how that looks. Okay, in this particular case, let's have a quick look at silver. Okay, excellent. We're looking at a 20.5 put for 15, and we're looking at a just a moment. We're looking at a so there's a sale again. As you can see, there's a 1-by-1 ratio. Otherwise, this would be a margin sale. If you sell more than one put per put purchased, the additional puts that are there are naked puts. And they would be incurring margin risk and an unlimited risk on the drop for every position, every additional position that was sold here. So let's have a quick look here at the values and the spreadsheets. Okay. And let's see, there are 5,000 troy ounces in the contract. We have the tick values built in. And I believe that we do have an input correction to make. Let me see. 20.5, perhaps it's at 11.5.
Yeah, I put the decimals in. You just need to take them out.
And 4.0. No worries. There we go. The great thing about the program is that we do have a guidance on how to do inputs, but if there's ever a mistake, you look at the output, you can see it, and that's what we're doing in our beta test.
Mr. Mueller?
Yes.
Just go ahead and take the decimals out completely. If you look at the premium example, it uses no decimals.
Okay. Very good. Just a moment. Actually, I clicked on the premium example. Okay. Just a moment. And we look at the ticks. Let's see if that intuitively makes sense. Just a moment. And yes. Now it definitely makes sense, because if you look at 20 cents and every penny's worth $3.75, we're closer. We're more more in the zone here. So we've got 57.50 minus 2,000. Okay, let's look at the tick values here. And we are going to go ahead and see how the layout again, the maximum risk and the maximum debit are corresponding numbers. You can see the net debit here was actually, when you factor in costs and everything else, that has to be 3860. That's the maximum risk. And the gain is the differential between the two strike prices. As you can see here, no matter how far the market drops, just a moment. Okay, I think that what we have here, thank you all for attending. I think we've just identified a code issue on the coffee put spread. So with your permission, we're going to put this one on the back burner and revisit the coffee market on a future occasion. This is the beauty of doing beta tests. Sometimes we find things that we need to correct, so we're going to get on that right away, and we will provide a coffee example.
Actually, it's working fine. I input the strike example incorrect also. Take the decimals out.
Okay, just a moment. Oh my goodness, this is Roy Weiler's day. Let me see. Nonetheless, that's okay. Thank you still for doing it, because it's the way we find things. And there we go. Now the software is working. Okay, sometimes we have input error, sometimes we have data error, but whatever it is, we need to fix it up. And here we are again. It's a 1-to-1 ratio. Now the numbers seem to make more sense. Hold on a second. Okay, so we have our maximum risk is as before. The cost of the transaction, the net debit of the transaction initially, is also the maximum risk. The premium break-even is 77.2, so one has to be able to offset this position for more than 77.2 cents. And in the futures, or in the underlying contract, one would be looking for a drop below 1972.8. So you really need this thing to go under 1973 or nicely above 77 in premium. And the maximum profit potential on this spread is 61.40. It's 21 cents minus the debit. It's 20 cents minus the debit, total debit paid between premium and fees. And as you can see again, on any sort of a rally, it's been determined already that the maximum risk is the debit. The break-even spot is indicated, and once we break beneath that objective or target price of 1850, that 61.40 becomes a fixed number, and no greater gain can be achieved because the rest of the gains are going to be, so to speak, taken off the table by the person who took over the right to that position at 180. So beyond that point, the trade is maxed out, and as you can see, because premium was collected, the break-even does get a little bit closer because of the cost reduction. Somebody turned around and said, well, I think that's a very big spread. I don't think coffee is going to really move that much, and trade's kind of expensive, and I don't really think it's going to go down more than to 195, for example. So a person like that could turn around and say, well, you know what, it's too much money. I'd rather make less but risk less and work with a smaller position. So for argument's sake, let's say such a person sold a 1950 put, and again, these are old prices, so maybe we can work with an old settlement price. What would the 1950 put have been around the time that the 20.5 was 115?
The 1950?
Yes, the 1950 July put.
It's at 72.
Okay, so in this particular case, that put would be at 72. So it's collecting much more than in the previous case, but also reducing the spread by $1 to a $1 spread. So let's see how that calculation looks. As you can see now, the person is spending less money because they collected $3,600. So they're collecting significantly more. The outlay and the maximum risk now is down to $21.50 plus the transaction costs. But the break-evens, again, now the high break-even on a drop is actually above $2 at $4.8, and the premium break-even is 45.2. So a much smaller move in the futures contract will intrinsically make this trade profitable on a drop, and a smaller percentage move in premium as well. The profit, the risk is limited, is lower than it was before, and it's predetermined. But as you would expect in an efficient market, the profit potential is also reduced from the previous number and limited to 27.40. And then again, as you look at the grid, there's a reminder of all the values, and we find our sweet spot. Our sweet spot is somewhere we want to get under 2, and ideally as close as possible to 1950 or below. Below 1950, the gains are capped, just as the risk is capped. Regardless of how high this market would go, the profits are capped, regardless of how low it will go. And again, on a risk-to-reward basis, people have to determine if this is or is not their sweet spot. Somebody who's bearish coffee with undecided volatility and doesn't want to do margin, or is bearish silver rather, doesn't want to have margin, then this is the type of transaction we just have to try different months and different strike prices and different premiums until something appears that is within the sweet spot of your expectations. I think that's that's our final example for today. Do we have any questions?
We have a question about one of the put spreads we had last time.
Okay. Very good. Was this in the? I believe we had that under the future spread. If you will look at the option ranger for educational purposes, we have multiple calculators, and the purpose for the multiple calculators is as an exercise in learning the markets. So there's a basic stock and futures calculator for stage 1 of learning with more basic information. Then at level 2 are the futures and combination calculators, and then finally the master calculator, which incorporates all of them. But during the learning and practice stages, it is good to work with the particular calculators that are designed for that stage of learning and that have accompanying them the types of trades that should be viewed for that type of learning. So let's look at some of the old trades. Was there any one in particular that people were asking about?
I think we did one in the gold.
Okay, let's have a look. Yes, I see here that actually exactly 1 month ago, for illustration purposes, and I believe we may have done a gold call spread as well at the same time, bull call spread. In this particular case, it was a bear put spread, both shown to highlight the similarities, the similar features of these trades with opposite direction. So again, in this particular scenario, the gold contract is 100 ounces, and in this particular scenario, the person was bearish for the market to drop, trending under 1320, and find its way to 1220. I think, again, whatever the values may be, that hasn't happened. In fact, the market had rallied and is just now pulling back. So I think, given a month of events since this happened, I think it might be curious to see where that spread is, considering that the market is still above the long put at 1320. So let's see here. We're looking at this particular trade. The transaction costs were in total were 34.10 in premium by factoring in the long option that was purchased for 5,400, the short option that was sold, the put that was sold for 21, which is 2,100 for a premium debit of 3,300 with cost factored in. It was 34.10. Intrinsically, the futures would have to break below 1285.90, and the premium would have to trade above 34.1. As you'll see in the all 1-by-1 spreads, the risk is limited and predetermined to the total initial cost of the transaction, and the profits are also limited because of the option that was written to collect more revenue and locking in a range. So as you can see again, in this particular scenario, the trade was at risk during a rally. Of course, there has been a rally, unlike with futures or other margin instruments. Somebody who had this position could have held on to their spread through the rally if they so chose, and it was fairly significant rally, and perhaps still be in the running at this moment in the trade because it was a non-margin limited risk trade to begin with. So just for curiosity purposes, can you tell us approximately where that spread would be trading today? The futures market is at 13.28.
It's trading at about 25.
So it's trading at about 25. The initial break-even point was 34.1, so let's just do the math from 34 to 25. So in a month's time, with the gold market being up quite a bit and then coming down, although the market hasn't broken to the downside according to bearish expectations, this particular trade has only lost at this point $9 or $900. So if a person wants to hold on to this trade, they can hold on to it. Or if they say, I've changed my mind about gold, I don't think it's going down with undecided volatility, then instead of sitting around and, again, running the risk of incurring the maximum loss of 34.10, again, a maximum loss of 34.10, a month later, somebody in this market who was mistaken on direction, really didn't go down, and volatility hasn't really apparently changed that much, or certainly the direction was wrong, they could turn around and instead of losing the entire 34.10, they could mitigate their losses, offset the position, come out with 2,500, which would give them a net loss of 910, assuming that filled. So again, this is the importance of monitoring positions. Although the market is still out of the money intrinsically, the market is not near the break-even point on the futures of 1285.90. In fact, it's still at 1328. Nonetheless, after 1 month with all that activity, it's primarily time erosion and being wrong on direction that has taken some of the value of this position, but one who changes their mind can still walk away with a smaller loss if they choose to do so, or if they continue to be bearish and continue to expect the market to drop, then they can just stay with that position, knowing that so far they're just down 9. Any other questions?
That's the only question we had today.
Okay, well that's outstanding. I want to thank you all for attending, and look forward to seeing you all tomorrow.